Hello, and welcome to the 2020 Summer Investment Update here from Pearl Planning. I am Melissa Joy, founder and president of Pearl Planning, and I'm so pleased to be joined by financial advisor Melissa Fradenburg. Hi, Melissa.
Hi, everyone. Welcome.
So we're going to dive right in. I want to first share the presentation screen and give us one moment so that you can see the screen. And then we're going to get started. Okay, so here we go. It's July. We are 6 months into the year, and it's been a year that's probably packed what feels like a decade's worth of information that has been factored into our markets. We've been on a huge roller coaster, and we're going to tell you what we have seen and what we see in the future. In order to do that, we're going to be focusing on a market update here at the halfway point. And we're going to, of course, be doing an update on COVID-19 and how it impacts market and the economy, some forecasting there. And then we're going to show you both a bond and equity outlook with some information we have on where markets have been and where we think they're going. And then we'll round things up with a summary of 10 areas we would like you to be focusing on, with a patriotic theme, shooting for the stars. Throughout the presentation, I have my email up, and I will welcome you to email us questions. We need them to be in an email format in order to have a record of them. We can't take questions from the presentation. So just send them via email to melissa@pearlplan.com, and at the end, we will be happy to answer your questions. Thank you. We'll give you a reminder at the end as well. So as we get started, much of the information that we're sharing today has been compiled by the Investment Strategy Group at Raymond James. And just as a reminder, I know that many of you are familiar with the kind of policies and procedures that we use for our investment process here at Pearl Planning, but we take the analytics information and asset allocation information from Raymond James and this strategist group that I've listed here. They're just representatives of a much broader team that has information about markets, technical analysts, economists, public policy experts, public health experts, etc. We use that information, and then we source and research the investment selection within the recommended allocations of Raymond James. So we're taking a lot of the information that your investment analysts are using as they form those allocation decisions. It's an incremental and important part of our process, and we think it's been very helpful during the pandemic to have such a fully robust investment research team that is really a part of our investment process. So just a reminder as we get started about kind of where some of this information is coming from. And so I want to dive right in and talk about what has been happening in the markets year to date. So we had a historic year in terms of the decline in the stock market as well as its recovery. So the first quarter was one of the worst quarters on record, and second quarter was one of the best quarters on record. It's interesting how those calendar time periods give us a full 3 months of kind of one and the other, but in reality, it was really an awful 6 weeks in the first quarter after we had a pretty good start to the year. And then the second quarter, no one would have predicted as of 3/31 that there would be such a robust rally in the market, but that's exactly what we saw. When you look at the left-hand side chart, it's called distribution of daily returns, but I'll simplify. This is just a look. If you look on the extremes, negative 3% on the left and plus 3% on the right, that's what percentage of days moved that much. And in gray, you can see the typical distribution over the last 10 years, an average distribution of, and almost all the time, things, are within 1% on a day, either up or down. If you combine those two, that would be 80% of typical, reality over a decade. But we have had significant extremes. So only about 45–50% of days have been within that 1% range. And in fact, we've had almost 20% of days that moved 3% or more. And first of all, this was a rocky ride, much more volatile, as you can see on the right, versus the last 10 years. So year to date is 2.5 times more extreme than average in terms of movements in stock markets. And also, though, if you had decided on a certain day in March that you just didn't want to be a part of that roller coaster anymore, then missing just a week, 5 market days of the biggest days or the best days in the market could have changed the 3% overall returns for the first half of the year in terms of S&P 500 to negative 33%. So big, important lessons that we'll probably be talking about for a long time about what it means in terms of process and decision making about whether you should stay in or out of markets. And it's one of the lessons that I'll be using as we discuss our commitment to kind of an investment process where our intention is to keep you allocated over time. But you know, we've lived through some extremely historic times in the last 6 months. Not of course not just in investments, but also in life. Now, looking forward, Raymond James has a survey where they go out and ask people in the know what they think the future holds. And they do this survey regularly. So we can see, you know, kind of changes and differences in terms of what we see in the future in terms of factors and pricing and the kind of crystal ball of the market. Now, first, I will mention that I don't think that crystal balls have a giant place in investment research, but it's still important to be cognizant of kind of where people think things are going. And first, there are some questions about what are the chances of a second wave in the future of COVID-19, which frankly, we're probably experiencing already. So I don't know how much of a question that might be, but a chances of continuation into the fall and winter, 75% think that's a probability. Now, of course, they're asking people on the investment side of things. So these are not public health experts, and information from both I think is relevant. If there's a second wave, do you think that there will be a nationwide shutdown or more limited on states and localities? People are tending to think that it's more limited. And then when will a vaccine be available? Second quarter of 2021, probability of about 75%. So we'll see. There's a lot of uncertainty. I think if there was an option of I don't know, many people would probably be choosing that. There has been a change in terms of in April, you know, the thing that was dominating most in terms of a sense of what is the future was COVID-19. And you can see that in the middle chart on the diamond where 55% of the macro factors that would influence the market over the next year. So the reason the market goes where it goes would be COVID-19 versus much lower on political and geopolitical risk. We'll talk about that more over time, but I think things have normalized a little bit. That might be that the novel virus is not as novel, and we're pricing it in, or in some ways, at least in markets or business, getting used to this new reality. I think there's a lot of uncertainty still, and the reality is that at any given time, something completely out of the blue can come up. Again, a lesson of 2020. And then targets for the future of markets have kind of followed what the market has done most recently, right? So, you know, we thought markets would be much higher when we started in January. That consensus estimate for an S&P 500 target went lower after a really bad quarter at the kind of depths of the market at the end of March. And then now we have a more normal in the middle kind of prognosis for where the market may be going. So we'll have to wait and see. And like I said, typically I don't, I want to be cognizant of where people tend to think things are going, but it's very difficult to predict the future when it comes to investing this year more than most. So moving on, let's talk about the information we have about the pandemic. Daily deaths have been declining. There's some new information. This information I'm providing to you was as of July 6th. So this week has been more challenging. Even in the last few days, some of those death totals have been going higher in certain hotspot states. Testing continues to increase, or at least is much more robust than we had a few months ago. And you can see that on the chart on the left, just aggregate tests as well as the rolling 7-day sum of tests. So that is good news. The percent daily positive was in decline, and we know that here in Michigan where Pearl Planning is located, but has been picking up over time. And then new daily cases are increasing. So, you know, the cases are a leading factor to hospitalizations, which we have some information on, which are a leading factor, unfortunately, to deaths. So this information is kind of murky, which or perhaps negative. But we have had 6 months to kind of prepare for these types of things. And the thing that our healthcare analyst is focusing on is what kind of prevention, therapy, and vaccine development is on track. So we have been watching and looking at different areas. There's both the potential for mitigation, whether it's wearing a mask or hopefully the anticipation of a vaccine. Some people are saying that vaccines may be limited in availability, which seems realistic, as well as efficacy as in the earlier days. But there is growing opinion that there may be a vaccine in the first quarter, or at least it's a possibility. So that's a mitigation factor, some way to prevent the virus from being transmitted. But there's also important, kind of research going on in terms of treatment once people are exposed to the virus and demonstrating and they are symptomatic. And that's where there's focus on remdesivir, other medical medications, anti-inflammatories, different treatment methods, as well as antibody usage in order to treat. And so all of these are developing, and that is information that is being factored into the market. I think that you would find in April and May, the market was very reactive to new information. It seems to be a little bit dampened, especially as the market has recovered so much. But we are certainly keeping these timeframes in mind as we think about investment decisions going forward. So then we're having an increasing area of focus, which is the election, which is coming up in November. So I think that there's going to be kind of co-dominant themes going into the second half of the year. Last, when we were discussing the investment landscape in our May call, we were hoping that we could see a diminishing coronavirus not in the headlines, but I don't think that's going to be happening. But, the top of the front page is probably going to be co-dominated over the next 4 months by anticipation of the upcoming election. And so I want to talk today not in terms of a perspective of who should win, but more of what happens when when outcomes happen from the election. Starting off with prediction markets or betting markets, which are looking at who will win the presidency in a way that is not is deemed by many to be less more objective, I guess I should say, less subjective. So prediction markets right now, as sourced by Bloomberg as of 7/1, are tending to dominate more for the presidency toward Biden versus Trump. You can see that in the middle chart area. But also Congress is up for grabs, especially the Senate. Right now the House is controlled by Dems, the Senate by Republicans, and so really it seems like perhaps the House will continue to be dominated by Democrats, or majority Democrats, and then the Senate is up for grabs. And prediction markets seem to be indicating that that there is that stronger possibility of a more, this dark blue line is the Senate and House both having majority Democrat. Now, on the left is the factors of the Raymond James Investment Strategy Sentiment Survey within their analysts, and a little bit different than prediction markets. They say that there's a 46% chance of Trump winning re-election, and Democrat, House, Republican, Senate may be a stronger possibility, 57%, with 31% for code House and Senate, both majority Democrat. So we'll have to wait and see. But we're going to be focusing more, first of all, I think that shorter term leading up to elections, markets really are focused on who's winning in the horse race. I think that it's much more of a voting machine, as Warren Buffett has said, than a weighing machine shorter term. So we can anticipate some volatility in markets based on the elections over the next 6 months. But then longer term, there's less consistent outcomes depending on which party is in control. So this is just a look at the electoral map and kind of the states that are up for grabs. Right now, they're leaning a little bit more toward a Biden election. We'll have to see how that is. A lot can change over the next 4 months. But then what happens when that election occurs? Well, typically people say that a divided House or a divided difference between the executive and legislative branch in terms of who controls markets is more helpful to markets. But we'll be coming out with an election piece soon that shows that, you know, there are time periods where markets are good and solely controlled by Democrats. Same for Republicans. It's not, there's not something equivocal that says that one party versus another is better for markets. So we'll have to keep an eye on that. But there is no longer term factor. And of course, this is weighing in. Both the Clinton and Obama administration had relatively good markets compared to what they were coming into from. So we'll have to wait and see, but we have more information coming out about that. And with that, I'll switch it over to Melissa.
Great, thank you. So Melissa talked about the risks with COVID and political risks. And lastly, another risk that we have to address for the equity markets is geopolitical risk. So if you see here, the dashed line along the bottom is sort of the historical average of geopolitical risk. And you can see, of course, in 2020 fashion that we are quite high for the year, both with Iran, as well as we have China continues to be an issue. And then with the elections, Russia and North Korea are also another geopolitical risk that we're going to have to contend with this year, and will have an effect. How these issues and tensions work out will have an effect on the equity markets. Now, after talking about all the risks to the equity markets, let's talk about a little bit of good news on the next slide. So many of the economic indicators are reflecting that we have already bottomed. We are coming out of the recession. So making this recession one of the shortest actually in history recessions. However, it is the sharpest recession we have seen in the history. So it's going to take some time to come out of it. But again, the good news there is that there are signs of a recovery, even in some of the hardest hit areas. You'll see TSA screenings, which is an indication of travel, is making its way up slightly. So it does look, if you look at up 615% from that market low, however, it is still down 75% year over year. If you look at unemployment claims, those bar graphs there in the middle going on the downward trend. Again, we are off the low by 5.6 million. However, year over year still up 19 million, which is quite a bit. Hotel occupancy, you see that in the chart, that looks like a great recovery there. However, we are still year over year down about 40%. And gasoline demand. A lot of people have been traveling by car because of the risk of COVID. So we see that nice recovery there. However, still down about 21% year over year. So by looking at this, again, the good news is that we feel we are in the recovery stage right now. However, because of the magnitude of that recession, even though it was short-lived, we have some making up to do. So looking at, by the end of next year, recovering from that at the earliest. And let's take a look at different areas of that recovery. So we are looking at, Raymond James likes to use the analogy of a K-shaped recovery. And what that means is some areas of the economy actually took off during COVID-19. So we have medical supplies, e-commerce, streaming. Interesting fact here, on average, viewers were streaming 8 hours of content during COVID lockdown. And actually, if you look at my children, are probably still streaming about 12 hours a day in content, as my husband and I continue to kind of work during the work from home without camps and such for our kids. So certain areas of the economy, again, it just really took off despite everything we were seeing. Now, the next would be a V-shaped recovery here. So if you look at certain areas, such as home improvement, surgeries, technologies, they have had a nice recovery over the last few months. So if you've tried to go to a home improvement store or even order some home improvement items online, you will see that people have a lot of projects going on. And in the survey, it said 78% of homeowners wish to make home improvements, whether that's because they spent more time in their home during lockdown or, and have realized that things need to happen, or just that they have some more time on their hands working from home. But that is an area of the market that has seen a nice recovery. Now at the bottom of the K, there's certain areas that, especially in the retail area, whether it was over leveraged or just really cash flow driven areas of the economy, that aren't going to make it. In fact, we're seeing record levels of bankruptcy filings back to the 2009 levels. And then, of course, there's an area that we do feel will make a comeback, but it's going to be a little bit slower. And that would be areas like airlines, entertainment, car sales. If people do expect to continue to have either underemployment or lower pay, then they're not as likely to go out and buy a new vehicle. So certain areas like that are going to take some time. Overall, target GDP negative for the year, 5.3%. However, looking into 2021, we are projecting positive GDP of 4.9%. So if we look on the next slide, again, some of those areas that we do feel are going to recover, but are going to take some time in that recovery, those are the puzzle pieces that you see outside here, outside of the GDP, which 2019 GDP was $21.4 trillion. And these outside puzzle pieces equal about $1.1 trillion that we need to make up as far as a recovery here. And one of the biggest things in making up this area is the psychological factor. So in a survey done by the Raymond James Investment Strategy team, 8% of people said by the end of this year that they would be willing to go to a crowded sporting event. 20% would be willing to get on a plane. 25% are willing to go back into restaurants inside. 31% willing to go back to work in an office space. So really, that is outside of what actually happens and what the risks are with COVID. This is just the psychological factor of when people will be ready. And so these areas like airline ticket sales, just in the tickets alone, that represents $314 billion for our economy. And that doesn't even include things like transportation to the airport and you know, and people that are employed there and work at the airports themselves. That's absolutely just in ticket sales. If you look at just Major League Baseball, they just announced they're cutting 100 games from the season. And when the season does start, they're not going to have fans. And that alone, their regular season is $10.4 billion for our economy. So if that's just one sport and the effect that that will have on our economy, not to mention, of course, restaurants with $240 billion that we need to make up. So this is just really as far as the impact of the virus and how long we foresee that this will take to kind of get back to that normal level. And a big hurdle to that is that psychological factor when people are ready to go back to that. Now, one of the saving grace here is we have avoided the doomsday scenario that some people have predicted. So for the fiscal and monetary policy, it has been swift and massive and unprecedented, and that has really prevented the worst case scenario from happening. So that's great news there. And let's take a look at specifically on the left-hand side, if you see unemployment. So it is estimated that there was a $1.1 trillion decline in employee compensation during COVID. And if you look at what that would do to consumer spending, that would have a negative impact of 8.3%. Now, with regular unemployment, we can buffer that a little bit. So that would be down 4.7%. But because of that added boost of the 600 a week in unemployment, as well as the stimulus checks, we are actually up as far as consumer spending ability at 8.7% year over year. So that stimulus, again, has really helped prevent some of those worst case scenarios that we saw in the beginning of this that could potentially happen. It is highly likely that we will see more fiscal stimulus to come. And it's no surprise that when polled, 76% of people said that it would be really important to have an additional stimulus payment to help them get through the summer. If you look on the right-hand side, one of the areas that's also been really hard hit is states. So states and municipalities and their ability to operate and balance their budget because they have seen fiscal revenue declines of 5 to 11% in some of the biggest states here, like Florida, California, New York. So as far as where we're going to see likely more stimulus would be for, again, individuals, unemployment, for stimulus checks, and then for municipalities to avoid having to cut employees and or services. And now if we look at certain areas of the market and what our thoughts are, if we look at fixed income and following with the patriotic theme here, US Treasuries earned their stripes. So what we mean by that is when we did see a downturn in the equity market, that US Treasuries did remain positive over that time period, and again, offered an important buffer for equity portfolios. So they earned their stripes, but when it comes to what we're looking at as far as fixed income, if you look on the left-hand side there, that chart shows if you are going to try and get yield as far as, additional yield in fixed income, obviously with interest rates being at an all-time low, you're not getting very much. But if you go from a 3-year treasury just out to a 10-year treasury, for that increased duration risk, you're only getting 47 basis points. So you're really not, for that additional risk, getting much more return or yield there. Now, if you look up, if you stay the 3-year duration, but you look up to the corporate space, that gives you an additional 97 basis points in yield. So as far as where we're looking for opportunities in that fixed income space, it does make sense to, again, go with a little bit increased credit risk for that extra yield. And if we look out, again, looking at duration and that risk there, we do think there will be a modest increase in rates over time, not anything dramatic, but even just a 25 basis point or 50 basis point increase in yield will cause some modest downside for treasuries. So if you look at, again, what happens in that corporate or investment grade corporate space, that is a little bit more attractive for the kind of environment that we see coming.
So thank you, Melissa. So I would just mention, it's stunning how low interest rates are right now. So, when we talk about perhaps having a little bit higher yield, I've heard people this week with the mortgage refinances well below 3%. So, it's important to put that in context when you're talking about, moving from treasuries to corporates, and that would have a 1% per potential increase in yield. If you only have a yield of 1.5%, a 1 increase can be a 60% bump in terms of what you're getting. So it's really, we've gotten used to low yield worlds, but again, we're experiencing kind of new lows with all the stimulus and monetary policy more recently. And when people ask me, why did the markets do what they did? First, I think that people are thinking, market participants are thinking long-term past this pandemic. I think, typically we have a very short-term attitude, but it's not the case right now. And then also it is very difficult to calculate the level of kind of accommodation that has been happening with that fiscal and monetary stimulus. That said, much of the movement in the market has been in those very biggest, very largest companies. The 5 largest companies in the S&P 500 equal 20% of that index. So the story, that K-shaped economy that Melissa was describing, is really a reality where you see, oh, everything seems to have bounced back. Well, that's not the case across the board. So there's very disparate outcomes that kind of general index returns may be hiding a little bit. But let's talk long-term. Why would you still be an equity investor? Well, first, look at the alternative of what Melissa just described, of very, very low interest rates. So you're not getting a lot of yield in your bonds. And also, if interest rates do start to rise, that is kind of a threat to bond returns. When you look, though, to the end of a recession, and we had a very sharp decline in the economy, and we're going to start to compare numbers to this very sharp decline. So, you know, you don't have to recover to the base that you were at to have a recovery. You just have to start growing versus contracting. Equities do tend to rally as kind of a leading indicator coming out of, or going into an expansion or coming out of a recession. So you can see on average, when you look at S&P 500 returns, indexed on average to the end of a recession date, going back to 1945. First of all, here's where the recession ended. If you look in the dotted line across the middle, you can see there's a recovery in anticipation of that in terms of the equity prices in general. And then in the next 150 days, you also get to the point where there's potentially additional returns. So that's just, you know, what tends to happen. History does not repeat itself, but sometimes it rhymes. So that is data that we're taking in. Equities rally very strongly out of a recession. It gets a little more, it's a dominant theme when you look at 6 months out coming out of a recession. It becomes more of a 80% probability when you look at it 12 months out. And this is data from FactSet on the chart on the right, equities rallying out of a recession. So just technically, typically when we study history, you would see that the results of, you know, kind of this time of the cycle, if we don't have a really hard stop to the economy, potentially are positive for stocks. Also, you're going to be registering numbers going into, you know, the earnings that you got in April of 2020. And again, we're going into earnings season now, are very, very low. Estimates are that, you know, forecast wise for the second quarter, a 40% drop off. But then, you know, if earnings rebound, even if they're lower than they were coming into the year, that's net over net positive. So that's also something that could tend to support better outcomes for stocks. And then there is a lot of cash on the sideline. Cash has certainly been your friend in this market. So where will that money go as it seeks to provide not only safety, but also return? One potential place would be markets, especially when you realize that there's almost no yield in, you know, kind of the safer side of fixed income or bonds. So there's also, though, reasons to be cautious, and also, you know, we just don't know. I think it's reasonable and respectable to acknowledge your uncertainty in times like this, and all the time, frankly. Looking just at, you know, where people think things may be, there's a 13% probability based on the investment strategy survey of 5% pullback or more in quarter three. And who even knows the percentage? Frankly, we just don't know. Looking at what asset class will be the best performer in 2020, 60% think that equities will be the best performing asset class. And if you consider that bonds have had a very strong year so far this year, that's really interesting. And the preferred region tends to be the US. That has been a theme for the last 10, if not more years, and continues to be an ongoing theme. That US just seems to not get burned quite as much as the rest of the world. We'll see if there's a change in leadership of that, but we have not seen it yet. You know, another threat could be that it's time perhaps to rebalance, and there's less fixed income and more equity after this recent rally. So that could pull some money away from the market. And looking out, you know, comparing the S&P 500 recovery with 2009's recovery, you know, shorter term, this kind of time period in the recovery was a little bit more of a challenge. And, you know, just acknowledge that every day is in a more volatile market. It doesn't have to go up. So we could easily get used to kind of this intense rally that we've had over the last 3 months. And it's not, you know, it's not going to be there forever. One note, we don't love international in general, although of course we have allocations overseas. But one area that does seem to be more, have more opportunities for growth and priced well continues to be emerging markets, especially Asia. The areas around Asia get a lot of their revenues from China, so it's a diversifier away from the US. I think that the rest of the world is experiencing, as we are kind of shut out from the rest of the world with, kind of the second wave of cases, there's opportunities for other areas to dominate. That's certainly not what we'd like for our country or our economy, but it reminds us that it's important to remain diversified. And then I'll just wrap up with 10 kind of lessons of asset allocation that we're emphasizing right now. There's a patriotic theme, shoot for the stars, that is kind of mirrored between the American flag and the efficient frontier of markets, where if you add in some bonds to your stock exposure, potentially you can reduce risk and in some cases increase return. And so that's overlaid to like kind of focusing on the stars in the market. But we are in a public health pandemic, so first and foremost, take care of yourself and be safe. Mental wellness and calmness, reducing anxiety, having conversations with us when you feel skeptical or scared or concerned about your money or markets. And certainly, we've talked generally about the economy and markets, but everyone is living their own individual story of challenges, roadblocks. That unemployment line that we see in a chart is a reality for so many of you, that we want you to be an advocate and a resource for you when you do need help. Hopefully you have a financial plan, and if not, we would encourage you to consider doing the work of financial planning so that you can revisit your plan when circumstances change and uncertainty is elevated. It's really important, we think, even though there are certain corners of the market, the very biggest companies and the most conservative bonds have been the best place to be. But we've learned time and again over time that diversification is helpful for an investor who does not have that crystal ball, which is all of us. Keep your time horizon in mind. So if you're nearing retirement, you may think that the end of your investing is the first day that you get your paycheck from your portfolio. But in reality, for most of us, your timeline is still decades long. So keep that time horizon in mind and make your investment decisions with informed intent based on that timeline. Cash is just magical in times of uncertainty. And, you may kick yourself that you have cash when you could get more money in the market in a year like last year. But we really love discipline and keeping in cash on hand if you have that luxury. If you don't, and things are tight right now, when you have the opportunity to kind of rebuild a cash reserve, that is, one of the first things that we think about in a financial plan. Talk with your advisor and make sure that your risk tolerance, your overall allocation, your portfolio makes sense. We're always happy to have that conversation with you. For some of our clients, and you're doing this every day if you're still able to contribute to a company retirement plan, dollar cost averaging, or just sending money in no matter what, once a month, once a quarter, once a year, that can help you. So you don't have to decide that this week is the right week to invest. It's just a part of your process and discipline. When you see big numbers in the market, number 9 is it's about percentages, not points. The market is much bigger than it was during 2009. And so, when you have 1,000-point day, it's a smaller increment than it used to be. On the Dow, 1,000-point day is down 4%, whereas in the Great Recession, that would have been down 14%. So don't be stunned by those numbers that are intended to, really capture your attention in headlines. And look to us or have conversations with an investment professional when you feel concerned. And long term, we remain optimistic. I believe in the adaptability and flexibility of the American investor. And I think that the individual one-on-one conversations give me faith in the country. There will be many unintended changes that come from the pandemic, new ways of life, new realities, discoveries that we wouldn't have found otherwise as we're looking for treatments for this. And in general, things tend to weigh toward more positive over time. So, I've said a lot, so has Melissa, but we want to give you some time to ask some questions. And just a quick reminder, as I'm going to be checking my email to see if anybody has reached out with a question, and you can email those to melissa@pearlplan.com. But also we have upcoming events. We're doing monthly, if not more, webinars, and we always post those on our website at pearlplan.com/events. You may have heard about this from either our LinkedIn or Facebook pages, but we're always sharing those as well. But if you want to stay in the know, you can sign up for our newsletter, which is at pearlplan.com/newsletter. And our next presentation will be on July 22nd at 11 a.m. And we're going to be talking about retirement readiness. We're really going to be discussing what is next, especially for those who had a kind of game plan of when they were going to retire. And then, things have completely changed, either because of their industry is in the bottom part of that K, or if they don't feel safe going back to work. We know that a lot of people are adjusting and negotiating a new reality, and we want to make sure that you have up-to-date information about how to prepare for retirement, and if you are just about to retire, what you need to be thinking about. So we'll both use some information on, kind of what's normal, but also, important steps that you should be taking. Melissa, any questions from you?
No, I think that was great. And I'm really looking forward to that retirement readiness presentation on the 22nd. So hopefully some of the people on this presentation will join us for that. But yeah, that was great.
And everything we have is recorded, so you can find it on our YouTube channel, and we'll make sure to send a recording to those who have requested it. And you can always check on our blogs too. We update them after we do presentations like this. But with that, I'm not seeing any questions. Oh, I've got one. Okay, so Gary wants to know any notion from RJ Gurus on the effect of a second wave close down. So the last information we have from them is the beginning of this week, which obviously, I don't think the numbers today are anything but an extenuation of kind of what we saw through July. So this presentation is really incorporating that, but I think that also political wins are being included. So there's the notion of how governments are reacting, which it seems, fortunately or likely unfortunately, are not consistent across states. So, that leaves personal decision-making to each individual actor and disparate outcomes from one state to another. I think the best outlook would be that there was a solid game plan that was evidence-based to reduce transmissions and rates, and we're just not seeing that right now. It may increase the potential if we're able to deal with this next wave over the summer, that we don't have to deal with a wave in the fall, but I can't say that that is certainly a certainty. Because of those changes, that might be the negative news that is necessary to do another wave of stimulus and fiscal and monetary stimulus. First, if you looked at a chart of what is kind of in the ammunition of the Federal Reserve, they have done a lot, but they also have really telegraphed that they're willing to do a lot more. So they've gone as far as buying assets and higher risk credit ETFs and things like that. So I would be kind of like the last 3 months. I think that potentially the investment outcomes may be different than the economic outcomes. And also the health outcomes of individuals may be different than the investment outcomes. But, kind of this repositioning and having hotspots in different parts of the country than the Northeast, where we were talking about 2 months ago when we did our last investment update, was kind of factored into the information that we've shared today. Let me see if there are any other questions. Oh, here's another. Okay, I hear that interest rates on conservative investments are trending toward very low for the foreseeable future. What can be substituted for a 50-50 retirement investment portfolio? It's a great question. So one thing is what Melissa talked about, which is credit. So looking at actively choosing safer areas, the parts of the K-shaped economy that are relatively insulated from the disparate outcomes of the kind of the economic losers. So there is a higher yield on corporate debt than there is on treasuries. A second area that we utilize in portfolios, and I can't, on a recorded call, I don't know how much detail I can go into this, but would be what we call non-traditional fixed income assets or alternative investments. that are fixed income. Some of them are dependent upon interest rates. So it just depends, but I think that that will be another area of interest. What I would encourage people to shy away from is searching for yield, because you can find things that have a very high yield, but they may have extraordinary or exorbitant risk. The yield is a way to price in the risks, and immediately I'm thinking of things that are heavily indebted, like energy companies. There's oftentimes people look at a chart that looks at equity investments versus fixed income investments, dividends from equities versus the yield in fixed income. And so, kind of equity income type strategies, I think, are also a source of income. Changing your mindset so that you're not only focused on principal, and keeping in mind that your income is, or your bond portion is not going to get you the income you want, but it will help to diminish the volatility in portfolios. So it's lovely when you can both get paid reasonably for having that safety in your portfolio. It's just not a reality right now. And lower yields may be here for longer. We think, there's certainly room for a little bit of a rise because things have gone so low, but there's going to be, until there's real change in terms of the outcomes right now, there's not going to be any sort of Federal Reserve increased interest rates on like a across the board basis. It's just not in the cards. There would have to be a completely new board of governors, new investment and economic landscape. So, it's a really tough quandary for all of us, especially retirees. And, for younger investors, when I got into the business, you could get 6% in a money market. Melissa, you probably remember similar numbers. And that is going to sound like a fairy tale to Gen X or millennial investors, because they've just never seen it. And demographically, there are also slower growing countries may not have those types of numbers. You may be looking in the rest of the world, so we mentioned emerging markets and stocks, but they tend to have higher yields in bonds, and there may be a way to invest focusing on that as well. Those are some of the things that we've kind of considered. Thanks for your question. Just refreshing my email to make sure there weren't any other comments, Melissa?
No, I think that was great.
Well, we always want to make sure that if you do have follow-up questions, we'll be happy to answer them offline. So here is our contact information. I'm out of our Dexter, Michigan office, and Melissa operates in our Grosse Pointe, Michigan office, socially distant, but able to be on a Zoom call together any given moment. We appreciate that you took the time to tune in, and I'll make sure that our important disclosures are also included. And we hope to see you on our next webinar or event. Thank you so much, and we'll talk to you soon.
Thank you. Bye.